How do you turn a floating rate loan into a fixed rate loan? That's what we're talking about today, and we use swaps. And my name's Hue Chen. I'm president of Saglo Companies. We own and operate shopping centers across Florida, Georgia, and now Maryland, 24 properties. We've been in business 50 years, and I would say that 10 years ago, maybe 12 years ago, I didn't know anything about swaps. When we're looking to put loans on our properties, we used your tried and true methods of either CMBS, life company loans. We talked to debt funds. We never did a debt fund loan, or banks with just fixed rate balance sheet, meaning that, hey, they fix it on their side, on their balance sheet, and it's just fixed for us. We know what the rate's going to be. And I would say that in the last maybe 8 or 9 years, we started doing deals with banks that would fix the rate via a swap contract. And at first, we weren't really sure what that was, and then we were explained what that was, and we'll talk a little bit more about it further into the video. But basically, the swap contract to the lender on their balance sheet, it's a floating rate. So for them, it's less risk because if interest rates go up, the floating rate goes up, and they're not losing any money. For us, it's fixed because when you enter into the swap agreement, there's a counterparty that sends you money as the interest rate goes up, and then if the interest rates go down below a certain amount, you send the counterparty money, so that as the interest rate from the bank goes up, it's always offset by the counterparty the other direction, meaning that you're either getting paid money as the interest rates go up, so it appears to be fixed for you, or as interest rates go down for the bank, you're paying money, so that you're still paying the exact same interest rate. So that's the fix. And so we'll explain a little bit more about it with Joe Long with Pensford. So, and the reason why I brought him on and brought Pensford on is because the first few deals that we did with swaps, we really, were novices at it. We didn't realize that you can hire a consultant or an advisor on your side to kind of look at the swap contract and the ISDA agreements and things like that, and get advised on like what you should try to negotiate or what you should ask for. Or even when you're looking at the swap rates themselves, what happens is that because it's floating, you lock it in via a telephone. So you're on the phone with the bank's swap desk, and they say, okay, I'm seeing 4.256%. Do you want to lock it in? And you have no reference because you don't have the Bloomberg terminals on your side, and you just say, I guess, and then you lock it in. And so what Pensford does, we didn't know this until later when we met them, is that they're your advisor, so they're also on the phone. They also have a Bloomberg terminal. They're also looking at the same rates, and they're just making sure that the rates tie, and that you're getting the right rate, and you're getting the right swap profit, so that you're so everything is how it should be. And we were able to meet actually Pensford, or I was able to meet Pensford at an ICSC dinner about 8 years ago, 7 or 8 years ago, shortly after we started doing these swaps. And I was introduced to them through a different company that was also using them. And then once we learned about their services, we're like, oh man, we really have to do this. And we've been using them every time. So if you are borrowing from a bank and it's floating rate, and you're needing this to fix it via the swap mechanism, this is definitely the video for you. And it's something that I don't know if it's taught a lot in colleges yet, but I can tell you that the majority of loans with banks today, you're getting your fixed rate via the swap desk. You're not getting it fixed rate balance sheet like the olden days. So it's certainly something you have to really understand. and it really pays to have the consultant on your side. So I just want to kind of give you that context, and we'll go right into the video. Again, my name's Hue Chen. I'm with Saglo Companies. So we're like, I'm on those calls, like, so I'm seeing it firsthand. I'm looking at the actual documents. I'm reading it over. I'm talking to Pensford. I'm talking to our lender. I'm carve out guarantor on some of these loans. I'm talking to you firsthand knowledge. So if you have any questions, comment below. If you find the content good, just like, subscribe, all that good stuff. All right, here we go. Thanks.
All right.
All right, if you're looking at this video, there's a good chance that you own commercial real estate, or you're in commercial real estate in some form or fashion, and you are financing a deal. The reason why is because something that is out there that borrowers like us use to fix the interest rates on a floating rate deal is called a swap. And we'll go into the details of it in a little bit, but that is what we are talking about today. Joe, what is a swap? Like, what's technically, how does it work? Like, why how long has it been around? I mean, I feel like I've only really learned about it like 7 years ago, but I guess it's been around for a while. And why does it exist?
Yeah. What the heck is a swap? And so I feel like that's what a lot of folks say, and they remember it from one of their finance courses, or when they took some sort of certification after school. But it's ultimately a contract that provides a fixed rate for a floating rate loan. And so a commercial real estate investor, sort of like yourself, gets a floating rate loan from a bank, and perhaps you don't want uh, floating interest rate on your loan. You want a fixed rate for the term. The swap is a separate contract that the bank is able to offer to the borrower, and it provides for a fixed rate over the life of the hedge and the loan, or however long they hedge for, and just provides certainty. And if rates go up, it provides a benefit to the borrower and continues to result in this fixed rate. And if rates go down, well, the borrower misses out on floating lower, but they still have the certainty of that fixed rate for the term of the hedge.
So let me get this straight. So let's just say I'm buying a shopping center, or I'm refinancing a shopping center that we own. And I go to my bank. Let's say it's, we work with various banks, but Bank United, for example, that's a lender that we work with.
Mhm.
And they say, hey, I'm going to give you a term sheet to lend on your property, and the rate that I'm going to give you is a floating rate deal. And because there's a lot of people that are watching this that might be thinking like, hey, when I bought my house, the bank just said, no, it's a 7% mortgage, it's just a fixed
Mhm.
rate. But in commercial real estate, you're seeing more often that it's a floating rate that the bank is giving you, not a fixed rate. And why is that? Do you know why? Or
Um, that's a good question. Certainly, balance sheet fixed rates come across and they have good terms. There are some benefits to those. I can't speak to why banks aren't always able to provide those. But in those cases where a bank is not in the, interested in providing balance sheet fixed rate options, or if their floating rate option is more attractive, the swap still provides an ability to get that fixed rate certainty you want for the term of the loan.
yeah, I had spoken with a few of my banker friends, and I was trying to kind of understand it as well. And the way that they explained it to me was that if like interest rate, total all-in interest rate is what we're most concerned about. They say that, look, we're going to give you a floating rate loan because when we're giving you a floating rate loan, it's less risk for the bank. And additionally, I think that they maybe have to reserve less cash or less capital against that loan
Mhm.
as compared to a fixed rate loan, where a fixed rate loan for the bank, like, put yourself in the bank's shoes now. If interest
Mhm.
rates, skyrocket, like let's just take, for example, 2021, 2020, 2021. the interest
Hmm.
rates dropped to like all-time lows, and banks at that time, I think the floating rate was, I don't know, like less than 1%. And so you're getting loans for 3% or 4%. And so if a bank on a commercial deal said, hey, I'm going to give you a fixed rate, uh, balance sheet fixed rate, not a floating rate of 3.5% or 4% over a 7-year period. Well, look, I mean, we're only 4 or 5 years from that, from that bottom of the chart time where the interest rates were 3.5% or something all in. Um, and interest rates go up. Now the value of, I guess, their I don't know how they value it, but I think that
Their
you know
investment, yeah.
their investment isn't as good because it's like now I'm getting 3.5% interest on this loan and I'm paying out like 4% to my depositors, right? So that doesn't make any sense.
That's
So
right.
for them, it's better to do a floating rate because they're like, okay, look, at least I
Right.
can get, as rates go up and down, at least I'm always making a certain profit, right? It's a little bit more known.
Right.
And and
Yeah.
and so that's my understanding. But I do still get a lot of term sheets that are more like fixed rate term sheets now, where they just say, hey, it's, right now the interest rates are 6.75%, and
Hmm.
the prepayment, it's a 7-year deal, and the prepayment penalty is 3.2.1, right? You prepay in year one, it's
Right. Right.
3%, year two, it's 2%, year three, it's 1%. And so I do get that every now and then, but maybe it's with smaller banks that might not have a
Hmm.
swap desk
Hmm.
or access to a swap desk. Um,
Right.
that's kind of, and I guess from a borrower standpoint, like I'm looking at it, okay, well, if I'm gonna borrow and it's a floating rate deal, uh, and I'm buying my shopping center at a certain cap rate, and it's, like it's not floating NOI. I mean, it's,
Hmm.
well, sort of. I guess if I
Right.
add the value, I can increase the NOI, but I want to make sure I'm good with my, with my yield there, my cash flow after debt service. How do I protect myself? I guess that's where swaps come in. It's like
That's
now
right.
I'm entering into a floating rate loan with the bank itself, like let's call it Bank United, but
Hmm.
not, and we also work with TD Bank and IDB Bank and Seacoast Bank. So we work with a lot of the banks. But let's just say we, do a floating rate. So now I'm entering into a floating rate loan with the bank. But now, are you saying that I'm also entering into another agreement, a swap agreement
Hmm.
with that's completely separate from my loan that basically to me keeps my interest rate fixed, but as the banks what they're charging me goes up and down, I have this swap
Hmm.
that's like the counterweight that kind of goes down as much as the bank goes up and goes up as much as the bank goes
Yep.
down.
That's right. Yep. And so let's say your loan with Bank United is SOFR plus 250, and you want to fix it, so you do a swap, and they give you a rate of 3.5%. So you add the 3.5% swap rate to your 250 loan spread. So going forward, you're fixed at 6%, whether SOFR goes to 10% or it goes to zero. The way it works is Bank United invoices you for SOFR plus 250 each month. And they say SOFR today is 430. We'll add 250 to it. You owe me 680. You go pay the swap desk 3.5. The swap desk returns the 430, and that 430 passes through to the loan side. And on a net basis, you're left paying the 6%. So the 350 you paid the swap desk, and the 250 loan spread you paid the lender. So the SOFR you received on the swap matches the SOFR you owed on the loan, and they canceled out. And so that's how a swap, the separate contract, provides for a quote fixed rate for the hedge term.
So now you brought up two questions because I think the
Mm-hmm.
audience that's watching this video, they're going to be wondering, what's a SOFR? Is that a person?
Mm-hmm.
Um, there's a SOFR family that's very prominent in real estate in Miami. And then the second question would be that I had for a long time, which I still don't really know the answer to, is who's on the other side of this swap agreement? Like, because for a
Hmm.
while, and we'll kind of talk about in the money and out of the money, but if you know, if like let's, classic is 2021 where interest rates are just crazy low. We're locking in.
Hmm.
We have a floating rate loan. Uh, I think it was with IDB, and we locked
Hmm.
it in using a swap. But but my understanding is if the interest rates for SOFR go up from the time we locked it, we're in the money, which means that if we
Hmm.
were to unwind the swap, we get a bunch of money back or from somebody.
Hmm.
And then if the interest
Right.
rates go below the SOFR rate, or not interest rate, the SOFR rate goes below um, when we locked, then we're out of the money, which is
Hmm.
means that we have to do a hefty prepayment penalty. So I was always wondering who's on the other side. But let's start with SOFR. What does SOFR stand for, and what
Sure.
is it?
Secured overnight financing rate. In short, it's basically the rate commercial real estate borrowers base or use for lending. Banks use for lending to commercial real estate borrowers on a floating rate basis. An alternative you might hear from time to time is the Wall Street Journal prime rate. But ultimately, these two rates are driven by Fed funds, or ultimately where Fed interest rate policy is set. So, as we all know, the Fed hiked interest rates over the past couple of years. They've cut a little bit, and again, today rates are around 4.30. SOFR rates are. Um, as the Fed
And
cuts,
that
you'll see
SOFR rate,
SOFR go down.
is
Hmm.
that a 1 day rate or is that a 30-day rate, or how does that, I mean, is it kind of compare when
Hmm.
I think of rates and I'm not familiar with SOFR, I automatically think of Treasury. And then I'm like, okay, well, I know there's
Right.
like a 30-day Treasury, a 2-year Treasury, a 5, a 7, a 10, is that the same as
Hmm.
SOFR or no? Like the
It's
way the
not. And
terminal,
so,
like the way that works.
yep. So the SOFR is an overnight or a monthly or even a quarterly rate in a lot of cases. But there's an overnight SOFR that changes every single day, and there's a 1 month term SOFR. It's basically the rate a bank would charge for 1 day of borrowing. There's a 1 month SOFR that is often um, used for 1 month borrowing periods, and it fluctuates daily as well. So there are a couple of ways of calculating SOFR, and a couple different indices we see in use with different banks.
Hmm. But who I guess it's driven by market, the rate itself. It's not like LIBOR, like because SOFR replaced LIBOR, right? Because LIBOR had like
Mhm.
a scandal where I think there was like 10 banks that was basically manipulating LIBOR or something like that. I don't know if that's the case, but is that the reason why SOFR is to where it is today as opposed to LIBOR?
Yeah, LIBOR was subject to manipulation, and it was basically a median borrowing rate every single day. The banks were polled and said, "Where would you lend money?" And they came back and they got rid of the top responses and the lowest responses and took the median, and that was the rate that was used for commercial real
The
estate
world,
loans. Um,
all over the
for the
world, huh?
world. It drove it
Gosh.
it drove everything, and the since it had some issues, and some of the banks were uh, basically providing responses that were too high, that to really manipulate the market and make some investments that or positions pay off. The basically the world said we need to move away from this to something that can't be manipulated as easily. And so they went to this SOFR rate, which is really just it's a broad measure of borrowing costs overnight using treasuries, or secured by treasuries. And so it's just a different rate that's based on actual transactions rather than polling a bunch of banks.
Okay, so yeah, I guess I think someone meant it described it as LIBOR was kind of backward looking and SOFR is forward looking or something. Is that true or no? Or not really?
A little bit. So you have a SOFR rate that's actually backward looking,
Okay.
and you have a forward looking SOFR rate as well. So it can get a little tricky, a little messy.
All right, so I'm gonna give the audience a little bit of insight of why they should listen to us because we're talking about a lot of very complex stuff. And so Joe, why don't you tell the audience a little bit about who you are, how long you've been doing this, what you do, and then a little bit about Pensford.
Sure. So I'm Joe Long. I'm managing director at Pensford. I've been here for about 9 years now. And Pensford was founded in 2009 to help advise commercial real estate borrowers on interest rate hedging and CMBS defeasance as well, which is a topic for a whole nother video. But we sit on the borrower side of the table and help them think through interest rate hedging strategies, risks, whether for one asset or their entire portfolio. And as markets evolve, different interest rate hedging strategies come in and out of favor. So we help our clients like Hugh think through the hedging strategies, take them out to market, negotiate fair pricing, competitive pricing, help with all the paperwork that goes along with it, and then ultimately place those interest rate hedges to protect their risk.
Okay, and then Pensford itself, how long has Pensford been around?
Yep, we're 2009 is when we were formed, and we're based out of Charlotte.
Oh, nice, nice.
So
Well, that's
coming
awesome.
out of the GFC, great
Yeah,
time to start a business.
yep, yep. And shout out to JP. He's super smart guy over I guess he's doing multiple things. He's got Loan Boss, he's got Pensford, he's got I don't know if he has other stuff, but he's got a good newsletter.
He's got a Loan Boss, the Pensford, a podcast, a weekly newsletter, and a whole bunch of kids, and an addiction to sports. So
Nice.
I think he has it all, and it comes at the cost of sleep.
So people want to get signed up to the Pensford newsletter. They just go to pensford.com and sign up, or
Yep, yep. You go to pensford.com. You can find the newsletter subscribe form on the homepage. And then if you'd like to hear the podcast, you can find that in wherever you look for your podcasts, or pensford.com. And the very top right corner, there is a gold link that's called podcast, and it'll take you to it as well.
nice. So a little bit about me. I'm Hue Chen. I'm president of Saglo Companies. We own and operate shopping centers across the Southeast and now in Maryland. We were founded in 1976. I've been in commercial real estate for 25 years. I do everything, leasing, acquisitions, property management, et cetera. But the company, Saglo Companies, we are vertically integrated, so we have all the different departments as well, and have a lot of in-house capabilities. But I um, really focus in on growing the company, and the primary way to do it is through acquisitions, and that's kind of how Pensford and Joe and I started talking. We have a little bit over 450 million in assets under management. We're planning to buy another 150 million of property in the next 2 to 3 years. And so we are trying to be very active there. And so for us to be able to execute on the acquisitions, the debt side of the equation is super important for us. You're really to a certain degree as competitive as your cost of capital. And that cost of capital, the debt part of it is usually the majority of that debt of that capital stack. A lot of people are borrowing at 60, 65% LTV, maybe a little lower, maybe a little bit higher. So that's a little bit about, who is on the video right now. And but I think the when we first met, like a number of years ago, it wasn't SOFR, it was LIBOR swap. Then it moved over to SOFR, and
Mm-hmm.
then the documents themselves that the banks would negotiate with us, those swap documents had like mechanisms on, hey, how do we equalize when we switch from LIBOR to SOFR? So that was a fun time. But we'll kind of get into that in a
Yeah.
minute. Regarding who's on the other, so you explained what the SOFR swap rate is. So it's an index rate. You said
Mm-hmm.
it's could be overnight, 30-day, quarterly. But then when you enter into a longer term swap agreement, like a 5-year swap agreement, I guess they're taking how do they get the 5-year swap rate? Because all these swap rates can be found on
Sure.
your website. I go on it all the
Right.
time.
Yeah. So in short, it's folks trading SOFR futures out there. And at any given time, there are other banks and hedge funds and pension funds and you name it, investors, in the market and taking positions. And futures are one of the many things that are traded, and SOFR futures are one of the many flavors of things you can dabble in, right? And so it's basically the futures drives the forward curve because that's basically a trader saying, a year from now, I think SOFR will be 1% lower. And so they're putting money on it. And so at any given moment, there's this, what we call the forward curve that's constructed. And it says, today SOFR is 430 and we think it's going to go down and it's going to level off around 320 about a year from now, 18 months from now. And then from there, it might creep up a little bit and it's just going to level off. That's just the market expectation for SOFR. And so when a bank quotes you a swap rate, they quote you if it's a 5-year swap rate, the 5-year average of the SOFR curve at this moment. And the idea being, if you're a bank's trader and you're Bank United and you're on the other side of this swap, you're saying, I'm indifferent between you paying me floating and you paying me the average of SOFR for 5 years. And so that's really where the swap rate comes. Banks make money on swaps though. Nobody does it for free. And there's, collateral and things going on in the background and they're going to make profit too. And so if the 5-year average is 330, then they're going to tax something on top of that. And they may say, we need to make 20 basis points. And so again, when we get on the phone with them and lock, they quote you 350. And so the bank will make a 20 basis point profit per year for 5 years. They'll present value that, and they'll recognize that as upfront profit. And so ultimately, that's how you get the mid-market rate, the break even, the bank tax the spread on top, you get the all-in rate, and that's how you get your 3.5% rate that you pay for the next 5 years.
Okay, I'm typing some notes here also so that we can go back to some of the things you said. But I'm on your website right now, and term SOFR is 4.353%. The Fed funds rate is I'm seeing it as 4.33%, and I don't know what's the overnight. I guess the Fed funds rate, is that also the overnight Treasury rate? Is that the same thing? Or I don't know. Is there an overnight Treasury? I'm kidding. All these rates are confusing me.
Not that I'm aware of. It's essentially probably what you could consider an overnight Treasury.
Yeah, I guess so. So I see that that's about the same, right? The term SOFR and then the Fed funds rate is about the same. But then when you look at your Treasury rates of your 2-year Treasury versus your 2-year swap, the swap rates are actually lower than the Treasury rate. And that's true across the board for the 2, the 5, the 7, and the 10. And I know like 10 years ago or 9 years ago when we were starting to do these swaps and using LIBOR swap, oftentimes the swap rate was higher than the Treasury. So right now the index rate of using the swap is actually more advantageous than the Treasury because it is lower by like a wide margin, like over 40 basis points. And so why is that?
Gotcha.
Why is the swap under the Treasury right now?
It's a great question. And there are like 5 different answers, and depending on who you talk to, you'll get a different one. In general, it's due to Dodd-Frank regulation and how treasuries are treated versus swaps on a bank's balance sheet or even some other group's balance sheets. In short, if you're a bank and you're holding treasuries, they're viewed as a little risky. And so you're required to post or hold more collateral on your balance sheet than if you have swaps. And so if you're a bank trader and you need duration, you need 10-year, some sort of hedge on 10-year rates, then you're more likely to use the swap than the Treasury because you have to hold less collateral for it. And so that just has generally created more demand for swaps and put downward pressure on swap spreads.
All right.
So the downward pressure on swap spreads means lower swap rates than Treasuries.
Yeah, there you go. So if you are in the market, if you own commercial property and you're looking to finance and you're talking to your lender for you to get the best rate, considering it's the same spread, like it's a 200 or 250 basis point spread on an index rate, it'd be better to have it the swap rate as the index rate rather than the Treasury rate, right?
That's right.
And and then, one of the things that I learned when which we didn't know because I would say we were let me think, this first swap deal that we did was probably it was probably like maybe 9 years ago. We and I think at the time, or maybe it's 10 years ago, but there was a period of time for the first few times we entered into swap agreements, we did not have a consultant like Pensford on our side. And so we would sign the term sheet with the bank, and they would price out our loan and say, okay, it's 210 over the the 10-year swap. And I had no idea of the swap profit. We had no idea that there was different swap rates. You mentioned mid swap, but then there's like other swaps that are technically still swaps, but just maybe even higher rates. And it's like the day of closing, you go and you're on the phone with the swap desk of the bank that you're dealing with, and they you have nothing in front of you. They have their Bloomberg terminal in front of them. You got nothing, and they go, okay, well, I'm seeing that it's like I think the rate's about 425 plus your spread. You're going to be at 7% or 7.12%. Are you good with that? And we're like, I guess. I don't know. I don't know where
I
else to
guess.
look. Sure. So the first few, I'm pretty sure we probably got hosed a little bit. So let's talk about like the different types of swaps. You mentioned midterm swap rate, but what other rates
Right.
are there, and what do you want to look out for?
I would say really two main swap rates just to keep in mind. You have, when you get on the phone with most banks, swap dealers in particular, like a Wells Fargo of the world, they're going to quote you two rates. They'll say, we have a mid-market of, going with the previous number I gave, 3.3. We can offer you the swap at 3.5. And the 3.5, a lot of people even say the first time they're doing the swap, well, I want the 330. Why can't I lock there? And the bank said, well, that's the break even. We have to make money. So we can lock you at 3.5. Do you want to lock or not? And so just know that there is a spread that's embedded. The break even is just the market's average of SOFR over that period. And you're going to pay something more than that. Part of our job and what we've helped you with, Hugh, in previous transactions is negotiating that spread, quantifying that spread, making sure it's a fair spread, and then making sure when we get on the phone to lock with the bank, they're quoting the appropriate mid that's in line with what our trading system says. They're incorporating the appropriate spread that we agreed upon, and the rate you're locking doesn't include any additional spread that's not supposed to be there.
Yeah. Yeah, I think let's dive into that a little bit because there's a couple spreads going on here. And I think most of the people watching this will understand the term spread, meaning that if my swap rate, or let's just use Treasury is a much more familiar terminology. If the Treasury rate is 4% and there's a 200 basis point spread, my all-in rate is 6%, right? Because it's just the 4% plus the 2% of the spread, and that's the idea of the spread. But when it comes to the swap rate, and I guess to anything like that, that mid-market rate is like the pure rate. The bank makes no profit off that rate. That's just the rate.
That's right.
And then on the bank side, the bank swap desk side, which I want to get into because a lot of times your relationship guy at Bank United or TD is in a completely different office than the bank's swap desk, and they have different motivations. And so you get on you're dealing with your bank. What we didn't realize until we spoke with you guys are that, okay, so I negotiated, a spread of 200 spread over the swap rate. And we're doing a 7-year deal, so it's the 7-year swap rate. And and let's say the swap rate is 400, same thing. But one of the things that I didn't realize was that you also have to negotiate the swap profit. I call it the swap profit. You call it credit charge
Correct.
or something?
Correct. We use them interchangeably.
Okay, so like credit charge or the swap profit. And what that is that uh like it's an add-on. So the banks will say, hey, look, the actual like no pro like we don't make any money rate is 3.75, but we're gonna add 25 basis points to that and to make it 4, because that 25 basis point is the bank swap desk's profit. And that 25 basis points is on your loan. Like if you're doing a $10 million loan, um, it's let's I'm not doing good
Yeah.
math in my head.
Let's quick math. 7,000 times 25. So
Yeah, so
175 grand.
yeah, exactly. So now the bank swap desk just made 175,000 off your profit, off that one
That's
swap transaction. Done. 175,000. So you can negotiate that. And I think that in general, I've heard as low as 15. I think 20 has been, more or less acceptable. 18's a good sweet spot. I don't know what you've seen out there.
I mean, and as with all things, it depends, right? But anything from a couple basis points for big public REITs to really small, kind of unsophisticated banks, 40 or 50, at least when we first started
40
talking
or
to them.
50? Oh my
I'm not going to
gosh.
say we accepted it. I'm not, yeah, but yeah, I mean, we've certainly been brought in on
So,
transactions
so,
where
so
there
just to
wasn't
give the
any
audience,
clarity around the pricing.
let's
Yeah.
just give the audience
Hmm.
context on that. So 40 or 50, that's per year basis points. So that if it's a 50 basis
Per
points
annum.
per annum and it's a 10-year
Hmm.
loan, they just made 5% on
That's right.
your loan at closing, like that first day at closing.
That's a nice closing fee. That's right.
That's crazy. So it's negotiable, but you're saying like big deals, maybe, it's like a $5 billion swap. Then yeah, maybe it's like five
Yeah.
basis points or something, or 4 basis points.
Yeah. Sometimes even less.
What's
Um,
the
but
biggest swap deal
yeah,
you've done?
I've seen several where the value of each basis point was a couple hundred grand. So um, yeah, it adds up really quickly. $1 billion swaps for sure too.
Wow. Have you've done a $1 billion swap?
Yep. Yeah.
Wow.
They don't roll through every day. They tend to, that these might start talking about the SASB market when you get into the loans that size. But yeah, we've certainly seen really large ones.
All right. Well, if there's any big, institutional guys watching this video and you got a $1 billion swap that you're getting into, give Pensford a shout. But let's talk about the swap desk itself, because it's,
Mhm.
over at the banks that we work with, we have a relationship manager, and they're great. They want to
Mhm.
get our deal done. They're the ones that collect all of our data on the properties. They get the deal approved by credit. They work with underwriting to make sure all the information is there and there's no extra questions. We negotiate the loan documents with them. And so like we're talking to them every day for, a few months, right? And then it's like
Mhm.
when it comes time to do the swap, and you're negotiating the swap agreements too. I think I don't what's the standard swap agreements?
The ISDA agreement. Is that what you're talking about? That we
Yeah,
always negotiate every time?
that's right. The ISDA. What
Yep.
is that? What is it?
International Swaps and Derivatives Association, but in short, we call it the ISDA, and it's basically this 30-page document that governs everything about the swap. And a lot of banks will send this form to you and tell you it's boilerplate. You need to sign it and return it before you can trade. It is highly negotiable. There are a number of provisions that you care about. And if you do a loan and you signed an ISDA and didn't negotiate it and everything goes well under the loan, probably no problem. But if the loan ever has issues or the bank wants to get out of the swap, sometimes there are provisions in there that they can leverage to get out of it. And so that's where you want to really tighten the ISDA up, and that's where we help step in.
That's right. You guys actually have is it attorneys, or have you guys just like seen it so many
Yep.
times that you just know what to do? Like, but you guys turn it around in like a day, right?
Yep. We have attorneys that we primarily leverage,
Yeah.
and so they negotiate ISDAs on behalf of our clients, and that's all included in our fee when we work with someone.
Yeah, let me tell you, if you want a good return on investment, the if you're going into a swap deal, hire Pensford. That is going to be the highest ROI on all of the consultants that you hire. But back to the bank swap desk. So like I said, you have this relationship guy, you've been working with them this whole time. And then like in the ninth inning, it's like, all right, let's talk to the swap desk. And the swap desk is usually in New York, or maybe it's in Boston or something like
Mm-hmm.
that, New Jersey somewhere. And these guys are just like Wall Street, like hedge guys. They want to maximize their profit, which is, it's capitalism. It's fine. They want to maximize their profits. It's fine.
Yeah.
That's what you need to do. But the important thing to note is that a lot of times the relationship manager that you have, like just they don't know the guy that's managing the swap desk. So like if you think like, hey, I got a great relationship with my guy at TD Bank, which should translate into their swap desk treating me well, that doesn't always translate. Is that right?
That's right. Yep, that's right. Um, Two different buckets for what people are getting paid bonuses out of. And so there is a derivatives revenue bucket and there is a lending revenue bucket. And the derivatives guy is certainly more incentivized to generate derivative revenue. And so, yes, to your point, he's not necessarily always looking out for the relationship. He's looking out for his bottom line. And sometimes you have to lean on your relationship manager to make sure that the swap guy is taking care of you as well. And that's another place where we're trying to make sure that everything is up to snuff and raise our hand and bring it to you. And if it needs to be bubbled up, then certainly can have that happen.
So you got one thing I don't think we finished talking about on the topic is that I'm one side of the swap agreement, right?
Mm-hmm.
I'm essentially paying floating to get fixed, something like that. And on the other
Fixed
side,
to get floating. Yep.
fixed to
Mm-hmm.
get floating, right? On the other side of the swap agreement is who is on the other side? Because if you're in the money or out of the money, if I unwind and I'm in the money and I'm getting, $1 million in the money
Mm-hmm.
fee back to us, who's paying that?
Right. So, we were talking about the SOFR futures. And so when you lock with your derivatives guy, he turns around to his trader and says you're done there, and the trader hedges out the other side in the market trading SOFR futures. So the people on the other side of those SOFR futures could be other banks and hedge funds and any market participant that's taking a position. So there's undoubtedly somebody somewhere down the line holding the bag when the market swings and you terminate that swap and it's in the money to you. Typically, bank swap desks aren't carrying that risk. They're making their money on that 20 basis point credit charge we talked about. They're laying off the risk in the market, and those hedge funds and other banks and whoever else is, you know, trading the SOFR futures is ultimately who's making or losing out on it.
Is there any chance of that other counterparty defaulting because they just become insolvent or something, or not really? Like you can only be that side of
Mhm.
the swap if you got like massive money or something.
Um, there's always the chance they default, but like in the GFC, you heard a lot about credit default swaps causing uh, issues, but you never heard anything about interest rate swaps, and that's because they're 100% collateralized by treasuries and it's recalculated every night. And so if there's some hedge fund facing, your Bank United trader and they suddenly become insolvent, well, as of last night, they had posted 100% of the mark to market value of that swap to Bank United. And so it's 100% collateralized. And so there may be, if there's a market swing, some little amount of money that gets lost, but it's pretty well collateralized, and so there's not a whole lot of risk that suddenly your swap that's in your favor by 500 grand, it's an asset to you, becomes zero because the hedge fund lost all their money. That the Dodd-Frank and the collateral and all that good stuff ensures that doesn't happen.
Okay, well that's good to know. Tell me about a story like of a huge win that you were able to, or anyway, that'd be huge, but just like
Mm-hmm.
proof of concept that, hey, I told a little bit about ours where, we did a lot of swaps, a few swaps without you
Mm-hmm.
guys, and we're just in a black
Yeah,
box. I don't know if we got screwed over or not. Um,
sure.
like, yeah, give me an example. Give me a story.
Um, I'll give you a couple. Like one that comes to mind was a group, and this is a bit of a larger loan, but it's still relevant. And it was a syndicated loan, had several participants, and the one of the banks provided an initial credit charge, and I think it might have been like 12 basis points. Shorter term swap sounded pretty good, right? But we went and shopped it around to the other syndicate lenders. And one of the other banks was willing to get more aggressive on it and do it for around 5 basis points. Well, the present value of a basis point was 100 grand. So you saved 700 grand by trading with one of these other lenders who's in the facility. So why would you not? And so that's what happened here. Um, so that's as simple as just talking to all the lenders participating in that deal. Now, typical deal for you guys is not a bunch of syndicated
But
facility where there's numerous lenders.
hold on.
Yeah, yeah,
What that one
sure, sure.
particular deal, you saved the borrowers $700,000.
700 grand. That's
So
right.
the I mean, you have to. I think your fee depends on the deal, but I mean, it had to have been at least 1,000% ROI on your fee.
I think it was healthy. Yeah,
That's a There you go. That's
yeah,
awesome. All right. Yeah, yeah.
yeah.
Sorry,
And
interrupt
look,
you. Yeah, keep.
and,
Yeah.
and well, and to your point though, I'll shoot straight. There are deals where the bank comes and says 5 basis points from the beginning, and we'll tell you, Hugh, this is fair. Like I think you're fine here. If you want to haggle over a basis point, we might be able to, but the bank is putting their best foot forward, showing they value this relationship and they want this business. And I don't know if there's a discussion that you need to have here. We'll tell you the same too.
Yeah.
So
The
you don't
and
we don't always hit a home run on all of them, but
you know what? Having
and I
the
don't
peace
think
of
every
mind is worth it.
yeah, right. And I don't think every bank's out to get you. In most cases, banks are great to work with, but from time to time, coming back to the story of the 50-ish basis point credit charge, get brought into a transaction. Um, it was, in short, a little bit complex. The bank was not a swap dealer, so there's a third party involved there, and the total spread was closer to 50 basis points. And after several conversations, we were able to get the bank down like 20, 25 basis points, and it saved the borrower 160 grand. And so, like, these are real things too, where it almost felt like the banks, the bank involved just didn't really know where the market was, and by having a conversation about what was reasonable pricing, they were able to come into something that the client was comfortable with.
That is like, after hearing that, especially if you're in the market, those that are listening, if you're doing larger deals, and generally speaking, the minimum size loan where it makes sense to bring in the swap agreement and involve the swap desk is what, like at least a few million or something, or
5 to 10, maybe.
yeah, right. So like 5 millions maybe maybe so you're doing a little bit bigger deal, right? $5 million deal, 10
Mm-hmm.
million, 50 million, 100 million, billion, whatever.
Mm-hmm.
So like the average smaller commercial real estate deal of like a $1 million deal with a $600,000 loan, they don't ever see this swap thing, right? That just doesn't make sense to bring that in
It's
at
not
that
as
point.
common for sure.
Yeah.
Right.
So I just want to make sure because some people that are watching this, they might be thinking, oh wow, that's maybe I can do it with my deal, but maybe their deal might be under the threshold. Recently,
Mm-hmm.
I actually at a dinner, I was having dinner with my friend Beth Azor, actually, who's uh, the first person that I ever worked for in commercial real estate. So she mentored me my first few years. And she would just casually mention something like, "Oh yeah, we're closing on a loan tomorrow." And I think I asked her, "Is it a swap?" And she says, "Yes, it is." I'm like, "Well, who's consulting you on that?" Huh? What? I was like, "Oh
Yeah.
yeah,
Who?
you should have someone on your side to make sure that, everything's good everything's in check." And she had no idea. And so I said, "Look, I got to introduce you to Joe and Pensford." And I uh, sent them your contact info. And like the day after she closed on the deal, she texted me, "Thank you so much. You just made the transaction a lot more transparent." And I think they were able to save a little bit of money on or a
Mm-hmm.
significant amount of money on that transaction. And and that was just like a couple months ago. So I mean, there's no reason why
Right.
someone shouldn't have Pensford on their side, right?
Right. Yeah. I think sometimes a bank will even like throw out pricing and float a number and just see. And if nobody raises a question about it, they just keep the 20 until they trade. And then we've certainly had instances like that where we get brought in at the 11th hour and there's value in us stepping in and just pointing out, like, hey guys, we worked with you guys a couple weeks ago and pricing looked quite different. Like, what's different on this one? And find out, like, oh, it's just nobody ever sharpened the pencil because nobody asked about it. And so, we like to be involved from the term sheet phase and be able to quantify pricing early on and even get it written to a term sheet so that it's easy and going forward we know what the number is and provide swap rate updates along the way and negotiate the docs. But if we get brought in at the 11th hour, we still believe there's value by having us and bringing us into the conversation.
Exactly. Uh, I know we're getting a little close to the top of the hour. Do you have a 2 o'clock call?
Mm-hmm. I'm free.
Okay, so we can go a little bit past, but
Let's do it.
swap unwind. How does that work? Because like, you lock in a lot. I might lock into a 7-year term or a 10-year term, but perhaps I sell the
Mm-hmm.
property in the middle of the term, and I need to now get out of my loan. For me to pay off my loan, I need to unwind the swap. When we say that, what does that even mean?
Yep. And so it's like a make whole calculation. If you've ever had to break a fixed rate loan, but basically think of it this way: we fixed you at 3.5, and you want to get out, and there's 2 years remaining. Well, the swap desk is totally fine to break the swap, but they don't want to be worse off. Somebody was expecting to receive 3.5 for 2 more years. And so we basically go back to that SOFR curve we were talking about earlier and say, what is the market average of SOFR over the next 2 years today? And how does that compare to that 3.5 swap rate you locked? And so if SOFR is projected to be 3.5 for the next 2 years, well, you're no better off by receiving this fixed rate than floating. So the breakage is zero. If the bank is looking at it and SOFR is projected to average 4, well, they're actually better off if they break the swap with you and go redeploy at 4% today. They'll pay you to get out. So the replacement rate was above the swap rate you're locked at. But if the rate is lower, let's say it's we're in the middle of 2020, it's COVID, rates are at zero. You're fixed at 3.5, and over the next 2 years, the bank's going to receive 25 basis points, at least based on the forward curve, there's a big problem. You owe the difference between 3.5 and 25 basis points per year for 2 years as a penalty. So that's 6.5% as a one lump sum payment. And so the swap can be against you by a lot. It can be in your favor by a lot, but it's all driven by what is the forward curve basically saying SOFR is going to average over the next, whatever remaining term is on the swap at the time.
So I guess that's the reason why, like, if the interest rate feels high, like if people feel like, hey, you know what, I think rates are going to go down in the next 2 to 5 years, or whenever they think they're going to exit the deal or refi. So if they think that rates are going to go down, then that means if they did swap, they would be out of the money and pay, like, through using that calculation, maybe a lot of money to get out, to unwind the swap.
That's right.
So at that point,
That's right.
I think you guys probably advise, maybe don't swap the whole thing. Like sometimes banks will say, hey, look, we're good if you swap half of it and leave the other half floating. That way you kind of hedge your bet a little bit. Or I think you've advised like, hey, maybe you just just keep it floating, but just buy a cap or something like that. So if it does go up and you're wrong, let's say if you're wrong and it goes up, then at least you got that cap that isn't going to kill you if the rates double or something like that, right?
That's right. Yep. Or sometimes, let's say it's a 5-year
Oh, yeah.
prepaid flexibility after year 3.
If you just repeat that one thing, your audio dropped for like a second.
Oh, okay. Yeah. Let's say you have a 5-year loan, but you think you need prepay flexibility at the end of year 3. To your point, maybe you do a shorter term hedge and ask the lender, can we do a 3-year hedge, make the requirement for a 3-year? And that way at the end of year 3, we'll revisit the hedge if we haven't already paid the loan off. And the end of year 3, when your swap terminates, there is no breakage. So it reduces the risk of that meaningful breakage.
Yeah, and that's the thing that I think a lot of viewers need to understand is that this swap contract, there's a lot of like creativity that can be there. On the inverse of what you just stated, I've also done, hey, if I want to stay floating for the next 2 years because I think interest rates are going to go down in year 3, I can do a forward swap, right? Or something like that, and lock it in starting year 3 to 5, or in some cases, like we're doing an A piece and a B piece, or like a line of credit. Like I do my main loan, and then I have like a line of credit for $1 million or something, but I don't know if I'm going to pull it, but I have 3 years to pull it. But when I do pull it, I do want to lock it in. So maybe I'll say, look, I want to do a 3-year forward swap so that it locks in year 3 and in the future from there, right?
Yep. Yeah. The challenging thing about these things is they actually are so flexible that sometimes you cause a little analysis paralysis thinking through all the options you could use.
Yeah, just ask ChatGPT, right? Do you ever just ask ChatGPT? Just ever ask?
It has all the answers. Where are rates going? We should ask that one today.
It might know. It'll give you an answer. One thing it'll do is it will give you an answer.
Yeah.
Oh man, that's awesome.
I'm gonna have to try that later.
So let's wrap this up. Why don't you give like a plug for Pensford and like all the reasons why people should give you guys a call, and I'll drop the link to Pensford in the description of the video, and just your suite of services and things like that, and I'll do the same after you.
Yeah, sure. Well, as we've talked about here, we eat, sleep, and breathe interest rate hedging, and are certainly familiar with all the options and know them front to back. And our goal is to not sell you on, or convince you, not even sell you, convince you to do one option or another. Like the bank is looking out for their bottom line. We're looking out for your best interests. And so we're trying to help our clients dial in on structures, negotiate competitive pricing, ensure that the agreed upon spread is what's embedded in the rate, and everything is transparent and smooth when you go to execute. We're trying to negotiate your documents to ensure that they're bilateral and everything is tightened up and in good shape if something goes wrong. And our job is to also keep you updated between the moment you sign a term sheet and the moment you close. And so we're bringing our expertise to your side of the table for a smooth transaction, an above market transaction, and to build a deep, meaningful relationship. So we would love to work with anybody that's thinking through different hedging options or has a need.
Thank you. And I vouch for Pensford. I think vouch for Joe. I think these guys are awesome. We've used their services for many years now. A little bit about Saglo, like I mentioned, we own and operate shopping centers. We have a 24 uh, community shopping centers across Florida, Georgia, and Maryland. We are looking to grow and buy additional properties. We are looking at other states now. So we're looking in Illinois and Ohio, Pennsylvania, Kentucky, Alabama, the Carolinas, Tennessee, et cetera. So Virginia, et cetera. So if there are any owners that were looking at this and have something in their portfolio that they would want to sell, reach out, DM me. I'll put my info below, link to my website below. But hopefully, everyone that watched this found this informative. And I know it can be very complex. Pensford's website is an extremely good tool, and I think that if there's questions about what we talked about, just put it in the comments below, and I'll try to recruit Joe to answer them. And look, I
Be
think
there.
this is educational all around.